much, and good morning. And I am IAIS Exco Vice Chair David Altmeyer and Florida's Insurance Commissioner, and really thrilled to have the opportunity to moderate this panel this morning on such an important topic, and looking forward to kicking off another day of outstanding panels with each of you today. So as mentioned, we are going to talk about culture and conduct and some consumer trends. My biggest challenge this morning is going to be staying out of your all's way so that you guys can talk through this issue with everybody. But I hope that you scanned the QR code. I might ask the team in the back to put it up one more time, just in case you missed it, because this is going to be an interactive panel. So go ahead and scan the QR code if you haven't already, and we're going to have an expectation that we get some insights from you also. So let me introduce our panelists. We have joining us virtually, you can see her on the screen, Elizabeth Arzadon. Elizabeth is a Managing Director at Kill Advisory Group. Elizabeth, thank you so much for attending virtually. I'm not sure where in the world you currently are, but I hope the time zone isn't too awful. Let's bring Elizabeth back just a quick second, if we could, so she can say good morning.
Good morning, everyone. I'm from Australia, so it's not too unsociable. It's not yet midnight, so that's okay.
Well, thank you so much for joining us. Immediately here to my left, we have Brenda Coode. Brenda is a Professor Emeritus at the University of Georgia in the Department of Financial Planning, Housing, and Consumer Economics, and I've had the pleasure of having many of these types of conversations with Brenda, so looking forward to doing that again. Brenda, good morning. To Brenda's left is Godfried Kiptum. Godfried is the CEO of the Insurance Regulatory Authority of Kenya. And then to his left is Fred An, who's the co-founder and co-CEO and director of Bowtie Life Insurance Company Limited. And then all the way down at the end is Mark White, the CEO of the Financial Services Regulatory Authority of Ontario, and also chair of the IAIS Market Conduct Working Group. And so Mark, I know you've got a lot of experience in the kind of conversations that we're having this morning, as do we all. So first of all, we're going to go ahead and throw up that first polling question that I promised you that we would have. So if we go ahead and put that up now. So I think this might actually be the third one, but we'll start with it anyway. What's the biggest risk arising from the changing consumer preferences discussed on the panel? Oh, here we go. We're going to go back. Perfect. This is the one we expected. What is the one word that you associate with consumer preferences? So we're going to ask you to wake up first thing in the morning. There's no easy multiple choice here. You've got to be original. What's the one word that you associate with consumer preferences? And then as those start to come up, we'll circle back to those in a few moments. But Fred, we're going to start with you Sure. on the questions. And I'm just going to ask you, what trends are you seeing in consumer preferences in the insurance markets, and what opportunities does that provide for insurers?
Sure. Well, thanks, David. Thanks for having me. It's my honor to be here speaking in the IAIS Annual Conference. I would say the consumer behavior is changing, and insurance hasn't caught up with the changes yet. And it's my first time traveling to Chile, and when I come here, I Google where to go. I ask my friends for the feedback. I look up the restaurant review. I basically did everything on the smartphones. So if you think about it, right, for the younger generation, this is actually their customer journey when they buy insurance, especially when they are buying it the first time. Digital adoption is increasing, and COVID only accelerated the behavior change. And during the lockdown, when we practice social distancing, internet become the only options to access health informations and also protection informations. So we are from Hong Kong. We are we are an online insurance company. You might ask the question, why do we need an online insurance company for a well-developed market like Hong Kong? Because there's actually a structural imbalance in the product mix. We have a concentration on the saving-oriented products because of the higher incentive for the intermediaries. So we're not promoting enough peer protection product like simple term life or medical reimbursement product. As an actuary, we thought this is actually great products with the highest protection leverage. So Hong Kong still face protection gap of about $900 billion, which translates into a quarter million per working adults. And digital insurer like us, our purpose is to address the protection gap. We want to provide the options for the consumer to get protection directly and instantly. In fact, it's a good channel diversification because for these underserved segments, again, it's very hard to reach them using the conventional channel. These are the people who don't want to talk to anyone. They just want to go online, they want to be in control. And since we have launched full virtual insurance in Hong Kong, we have seen that more traditional players are entering the digital market. We have seen that there's a shift in selling more protection products, and we're working together to address the financial inclusion problem. And in terms of the opportunity, that one word that I see on the slide, right? I would say beside convenience, beside cost, the word that I will pick is transparency. Because consumer would demand greater and greater transparency when they buy online. They would like to research, compare before they buy. They will want to know exactly what is covered, what is not, and why the policy terms are designed in a certain way. And without that transparency, the consumer cannot find the information they need to make a well-informed decision. So I would say transparency is good, but at the same time, I don't think insurers are becoming more transparent. There's a lot of information online that we cannot find. And sometimes I even see that we're hiding some of the online feedback. We don't want people to see it. So my humble view is I think transparency will win trust, and transparency will drive more positive behavior, and that will be a good solution to the conduct issues.
Excellent insights. Thank you. Thank you. So Gottfried, I'll come to you next, and Mark, you can be thinking about it because I'm going to ask you the same question. But Gottfried, starting with you, how are you seeing consumer preferences change in Kenya, and what's that mean for your supervisory focus?
Thank you, David. I think we have had a lot of developments in the recent past, and one of the things that people in our country want is they want to access insurance. They want to access insurance in a manner that is very convenient. And possibly for those of you who know, Kenya has a very high digital penetration levels. So that is what they want to access insurance through those platforms. They also want to be able to compare pricing from various quarters, various players, and be able to choose on the digital platform. So they want to see all those benefits, the offerings, the pricing, the policies that will be given, the policy wordings in a simple and transparent manner, and in a manner that they can be able to relate to whatever is being offered by those various companies. So with that level of transparency and the ability to choose and whatever they want, that is where they want to go. Thank you.
Thanks, Gottfried. So Mark, same question, except obviously you can offer us your insights on Kenya, but we'd prefer to hear about the same question in Canada. So.
Well, great. Well, I will build on what Fred and Godfrey had to say. So definitely agree with the changing purchase behaviors. That's a fundamental thing that we're seeing across Canada in discussions with the Market Conduct Working Group. The ramifications of that, though, I think are also quite significant. It involves, thank you. It involves the consumers, though, giving up information about themselves in a digital age, which of course can be used to their advantage, but can also be used to their disadvantage. There are algorithms that will track them and understand their behaviors and start to target them for products. It can also be used for risk analysis, which can be also for good or not so good. Is that better? All right, let's try that then. Moving on, there was also some other things. Now, the first one is, and this is related to the fact that people are buying things online, but there's more and more incidental purchases of insurance. And so that could be when you're, buying a travel package and then you're looking to buy insurance, or a simple credit product and you're buying insurance. And so there are unique consumer issues caused by those insurance purchases as well. They tend to be quite spontaneous. There doesn't tend to be the ability, Godfrey talked about, getting information and making wise choices. That doesn't tend to happen. It tends to be a bit of a sole sourcing arrangement by the bundling of the insurance products. Interestingly, in Canada, on the life and health side, we're seeing, and we think this is because of the interest in savings and retirement and focusing on overall financial wealth, we're seeing that whole life and universal life policies, which tend to be more complicated policies, they have a savings element to them, they're actually growing quite significantly. And the trend to buying term life insurance, which had been all the rage for many years as the simple way to protect your family, is actually going down quite materially. And this, of course, when you combine that with the fact that people are now trying to buy digitally, and the fact that these are complicated products, advice is very important to make sure you're buying complicated life and health products well, and that you're doing so in a way that is well informed. We also see there's a lot of consumer confusion out there in the marketplace. So the role of the agents, the distribution channels, about making sure they're getting good information and making sure these are suitable products for those individuals, I think is a really important objective as well. There's also just some new consumer products out there. So e-scooters, car sharing, Airbnb, all of those things raise new insurance issues. And of course, people need to have their insurance for those channels, particularly as they're putting them out there in the public space. There's old risks, which are changing and evolving, and all the discussions we've heard yesterday, and frankly throughout the IAIS work on cyber, on natural catastrophe. What are those policies? What do they cover? What are their exceptions? So even with traditional insurance products for traditional risk, there's a lot of change going on. And there's also, interestingly, inflation is a new consumer preference driver. People are trying to economize on their insurance, but at the same time, the assets they're trying to protect have gone up 10, 15, 20% over a few years, and they have to actually increase their coverages at the times when they're trying to economize on their premiums and decreasing their costs. So there are coverage gaps out there. And the final preference that we see is there's a great preference for companies that are green, that are climate positive, and have those products. And what that actually means, though, for insurers, so some insurers are starting to step up, and they actually, I believe, are doing it with the best interests, that they actually want to have a climate positive footprint. But actually getting there, it is a bit of a challenge.
So thanks for that. I especially appreciate your comments about the role of an agent or another professional in a lot of these complex products. So thanks for that. So Brenda, we've talked a lot about changing consumer preferences, but would be curious into your insights into what consumer preferences might be staying constant.
Mm-hmm. And again, I'd like to start by saying thank you for the opportunity to be here and participate. I think there probably are a number of consumer values that are demonstrated in most purchases, including insurance, and probably always will be, but I'm going to focus on just two. So one is security. Obviously, a primary role of insurance is to provide financial security. And yet, if we get it wrong, if insurers, supervisors, companies, consumers themselves get it wrong, then we see insurance is actually a source of financial insecurity. If I have to worry about whether my company will remain solvent, if I have to worry about whether my claim might not be paid, or I think it might not be paid in a fair way, if I have to worry that my premiums will increase beyond what I can afford, and even if I am concerned that a company is selling or sharing my personal information in ways I don't understand, that might bring risk to me. The other basic value that I think is enduring is we all want good value for the money that we spend. But if you think about insurance, it is incredibly difficult for a typical consumer to determine if they're getting good value for their money. Often they're buying a product they won't see until after they've bought it. We don't often see the policy in advance, and a product I might never use. How do I know whether I got good value from that? When I buy insurance, there are services attached to that, but many of those, again, I might never use. I may never file a claim. And if I do use a service, I might do it so rarely I have no basis for comparison. I don't know if this was subpar or excellent because I have nothing to compare it to. So I think that's why we see consumers expressing value in things that they can assess. Is it convenient? Can I use my smartphone? Because they don't maybe know how to assess the basic value of the insurance product that they're buying. So I think security and this desire for good value for their money are two principles that we should look to going forward. Thanks
for that, Brenda. So Elizabeth, we're going to go to you now, and I'm curious from your perspective, what does behavioral science tell us about how consumers make decisions and act? And based on that, do you see any new or heightened risk for insurance consumers due to their changing preferences?
Well, I'm going to continue on the theme of things that might be staying the same, actually, and suggest that there are some things about human behaviour that we know drive consumer purchasing preferences. And some of those things have not changed, but what has changed are the conditions in which consumers are purchasing products. And so because of the interaction between some common human behaviours and changing conditions, we see new types of risks, and particularly maybe new types of risks that some of the traditional mitigation of conduct risks might not be addressing as easily. So to put a little bit of flavour around that, there's a very simple framework that the behavioural insights team in the UK uses to talk about what drives human behaviour or purchasing decisions, and it's called the EAST model. And it says that people are more likely to purchase products when it's easy to purchase them, they're attractive, they are socially desirable, and they're timely. It's a timely purchasing decision. So if you think about those tendencies to purchase under those conditions, and then you kind of layer on top of that some of the changing conditions, we can see how that might increase some of the risks. So if we take ease, and I think some of the other panelists have talked about this in regards to digital platforms for people to purchase things, purchase insurance products. It's increasingly easy for people to, pass through an application to purchase a product where there might be AI technology drawing in data from various places, pre-populating forms. It's a very quick process as opposed to sitting down with an agent and going through a laborious process of filling in an application. It makes it a lot quicker when you've got technology to enable that process. And so the ease with which people can purchase a product quickly and spontaneously can be a good thing. It can make it easier for customers, but it can also maybe that time that it takes to go through an application can also give people more time to consider whether a product's suitable for them, whether it's good value, and so on. So that would be one example. Another one which springs to mind is the social dimension. So I'm sure people have heard about the concept of finfluencers, where people today are taking some advice from celebrities or other people that they admire on social media on a range of things, including their financial decisions. And so when products can be made more attractive because we have social media personalities talking about them, whether or not they're actually suitable is of course another matter. So that's another example of a common behavioural pattern of things being socially desirable, you want to purchase them, interacting with new conditions where you have social media and influencers. So I suppose to kind of wrap that up or sum that up, I think what we're seeing is some very stable characteristics of consumer purchasing behaviour interacting with changing conditions that are creating risks that may not be, or may be different to what we saw in the past, and therefore some of the ways that we had to deal with those conduct risks, for example, having to sit a person down with an advisor or an agent to talk them through the products. Those things which were actually could be quite helpful to ensure that a product was suitable. Those things are no longer as much a part of the purchasing process as they were in the past, and so that's why we see more risks. Or different risks.
Thanks, Elizabeth. Thanks. So that wraps up kind of the first segment of what we wanted to cover this morning with respect to consumer preferences. So this would be a good time to bring up what our word cloud might look like. So price, right in the middle of the word cloud. And speaking just for supervisors, I can tell you that's oftentimes one of the most challenging things to balance between affordability and the reliability of products, but obviously a very important one. Value, choice, and fairness are prominent there. Convenience. Looking around the edges, fairness is a small one on the edge, but we can loop that in with that fair. Kind of surprised easy to understand is a little smaller. I thought that might be a little bit bigger. But let me just ask the panel just generally, any insights or takeaways into some of the words that you're seeing on the screens now?
Well, I would just say that, that the big words are sort of resonating with my idea that we all want good value for the money. And as an educator, I would love to see literacy being a much bigger word there. So,
Excellent.
Yeah. And I may add to that. So when I look at the words that are coming up, and then I think of, the comments about the speed of purchases and the difficulty and the online activity, it's actually at odds with, because when fairness, price, and value are all actually at odds in a way with convenience and choice. And so as supervisors, recognize that people want to do things quickly, they want to do it simply, but nevertheless, we actually want them to be able to take the time to evaluate what is the right product, what is suitable, is it to comparison shop. And so as a supervisor, that actually puts more onus on us, because we now have to try and fill in some of that gap that consumers are not going to take the time. And I also think there's a greater expectation that of both insurers and of supervisors by the public, that we are actually doing that protection for them. And so the fairness really comes to roost, I think, in the public view with the supervisors and with the companies. And I think that's actually changing insurance regulation as well, and also the role of insurers, because they, of course, have a prized place in society by having that license.
Excellent. So thanks everybody that participated and is still participating in our word cloud. Value seems to have overtaken price. Okay. So thanks for that. So let's go ahead and put up our second audience question here. So we just spent a fair amount of time talking through changing consumer preferences, and so would ask the audience to think about this question as we move into our next segment. What do you think is the biggest risk arising from changing consumer preferences? And you can see we've made this one a little easier by giving you some options to choose from. So go ahead and put your answer in, for that one, and we're going to move on to the next segment of our panel. We're talking a lot about conduct of insurance entities and consumer preferences, and so it's important for supervisors and firms alike to have good indicators for what we can use to ensure better outcomes. So Mark, you're going to be the logical place to start on this one as chair of the Market Conduct Working Group. Your group's recently published a report on these issues, and I wondered if you might kick us off by giving us some insights into what this report found.
Yeah, thanks, David. And this builds very well, I think, on the first questioning, because and my comments about the role of supervisors, we actually, I think, are taking more onus on all the time. And to actually do that in a world of increasingly complex and evolving insurance products and the way they're purchased, we actually need to find a way to supervise which is more effective than, I'm not saying that traditional going in and doing field reviews and examinations aren't important, but we actually need to find a way to target our resources. And that's what the conduct indicators is about. It's about getting supervision to the level where, and sometimes they're very quantitative and sometimes they're qualitative and require application of judgment. But what we've found is that supervisors are increasingly looking to find tools, information, data, so they can be risk-based in their supervisory focus on conduct. And so the conduct indicators work really is at the core of that. And we had over 50 authorities, supervisors coming in and giving us information. And it helped us to really understand that there's a wealth of knowledge that is out there in supervisory practice. We found that supervisors generally have the powers that they need to get the information they want. There are, of course, issues where sometimes the industry can be reticent, and I do understand there are costs. There are issues of having to provide data the way the supervisor wants it, so that could mean retooling the information. But nevertheless, it is worthwhile. And we've also found that then the supervisors, of course, have to be able to get that information in a way that they can learn how to use. And often that requires different skill sets within the insurers, within the supervisors. So it is a real investment, but we're seeing that supervisors are willing to make that investment. Interestingly, it's not that many conduct indicators that most supervisors are trying to get. It's only around 20 or so is like the average, and it are heavily focused on claims and complaints, because those are indications what claims and how they're processed and what's going on in the complaints. And of course you can see from that you're not going to get direct information that there's a conduct violation, but you're going to get a lead that if you watch the trends, that you can see that it is now time to hone in and do more, cross-sector reviews, deep dives, additional surveys on what you're finding through that complaints and claims data. Interestingly, supervisors use this in a variety of ways, but two main ways. One is to actually guide them with respect to, so what is the misconduct that might be going on? And then they can drill down, as I said, through thematic reviews. The other is for risk assessments, and that can be both overall risk assessments going into, and I think increasingly supervisors want to have a holistic view of the insurers they're supervising. So looking at prudential and conduct together. And so these conduct indicators will help inform that holistic view from a conduct perspective, and will also then drive, is there a place that you really should be digging down? The challenges we found, and these are in the report, are mostly, I'm sorry to say, related to insurers. Often they don't prioritize this, they don't have a great understanding of the conduct requirements, the data quality can be poor, and as I said earlier, insurers do of course see this as burden, but I think in the longer term, the investment for both the insurers and the supervisors to work on conduct indicators from a data and analytics perspective will actually pay dividends to both the industry and to supervisors. And finally, I'll just mention, David, that this isn't the end of the work. There's a members-only piece that we're working on where we're really going to distill all of the different lessons we learned of how supervisors have successfully used conduct indicators to get at different conduct issues. And we're going to share that so that supervisors will have that wealth of knowledge, so that if you're looking at, so if I collected a certain type of data, how could I use it? Or if I'm concerned about a certain type of issue, how has data been collected before and utilized by other supervisors to deal with that issue? So a very important area, I think, for everybody in the room.
All right, thank you, Mark, and obviously thanks to your group for their important work. And I added some sound effects there to your response. I apologize for that. I'll keep my hands off the microphone going forward. But Elizabeth, I want to turn to you and ask you, what indicators do you think are most useful for emerging consumer risks?
Yeah, I'm really interested in this topic because I think when I look at what both supervisors and indeed insurance firms also try to analyse when it comes to indicators of conduct risk, it's often, as Mark just mentioned, emerging trends in what I would characterise as actually lag indicators of conduct. If we've got complaints or you've got problems with claims processing, then it might be early, you might be able to catch it early when you see the trend, but it's an indication that already something is going in the wrong direction. And so the indicators that I find most interesting to think about are the ones that might tell a supervisor that there is an increased pressure or likelihood of a firm starting to go towards having conduct or cultural issues. And there are actually some research that our firm's been doing to look at the types of factors that or types of indicators that might suggest a firm would be under more pressure, and therefore that pressure may translate into increased conduct risk. The types of things I'm talking about would be quite factual indicators, so things that are either common across an industry, things that are outside the firm, like changes in the product mix, changes in indeed consumer expectations, changes in the economic conditions. All of these are things that might put pressure on a number of firms across an industry or within a jurisdiction, and might increase the likelihood that firms will start to try to compensate, or there may be increased ambiguity around the communication that they have with their customers, and therefore that can translate into increased conduct risk. So those would be some sort of common types of things, but also indicators that might be context dependent for an individual institution. So things that might be going on for that institution at a particular point in time and might fluctuate. These would be things like changes in leadership, or changes in strategic direction, maybe mergers and acquisitions or restructuring, maybe particular growth ambitions or targets in a year, or indeed cost pressures as well. So these are types of things that you might look at might be indicators for an individual institution. I think it's very, very useful to look at the types of indicators that Mark was talking about in terms of those emerging trends in complaints and in claims processing and those sorts of things. But in addition, I think looking at indicators of pressure that might be lead indicators of conduct risk or cultural risk are also very worthwhile looking at as well.
All right, thanks. So Godfrey, I'll turn to you at this point. So in Kenya, what approach do you have to identify and act on conduct risk indicators, and what would you characterize as some of the challenges that you all might have as you face that?
Thank you. In the kind of market that we operate in, where we are now pushing that security to insurance companies as opposed to the initial where security was provided by the communities, it is extremely difficult to provide that kind of market conduct issues. But nevertheless, the authority has several approaches that has put in place that we look at the product life cycle development from the time a product is being brought into the market. The authority approves, therefore making sure that some of the issues that would arise are prevented at that point in time. We also look at the promotional materials, what they are selling, how they are proposing to sell it, and who they are targeting it to. And at that point, try to also prevent some of the issues that would arise in a preventive manner. So we also do proactive, preventive, and reactive. At the end of it, we also look at the after sales, the kind of complaints that come from the market, and how do we then act on it so that we stop it going forward, or how do we make proposals to these companies to sell it in a particular manner, make promises that they are able to keep in the long run. And also we look at their capital adequacy positions so that they are able to meet the promises that they make. At times, of course, you'll find that you want to overpromise so that you can be able to sell and distribute and beat your competitor, but in the long run, it may be very difficult to be able to do that. So those are all the things that we look at amongst others, but it is a very challenging environment, taking into consideration the kind of market we are dealing with. But we are hoping that with a better understanding and adoption and acceptance and people accepting insurance business and products, in the long run, it will be much better. We have also tried to make sure that the policies that are being sold in the market are quite simple, understandable, and many of the people can be able to relate to it and accept those kind of policies. But all the same, we are saying that the market has done very well and very good growth, and we're having a number of challenges, of course, especially in terms of information that is being passed to the customers and whether customers are getting fair treatment. We do also have checks that we run quite a number of times. We do assessments from a customer point of view, how they think they are being treated, is the treatment being fair? We have adopted a system that is called TCF, Treating Customers Fairly. We do carry out assessments, companies, and we also have independent assessments every 2 or 3 years to see where we have reached. And we have made good progress despite the challenges. Thank you.
All right. So Brenda, this is an area I know you've spent quite a bit of time on throughout your career. So what views do you have on the indicators that supervisors should be using?
So I read the report that Mark referenced, and I think I'll make 3 major points. So one, I was struck by the reliance on complaint-driven data, which appears to be very consumer-centric and appropriate. But the heavy reliance on that means that it's extremely important that there be an appropriate, agreed-upon definition of what a complaint is, and then it be consistently applied. And I would also caution that since most consumers are not really knowledgeable about their insurance, they may identify the source of the complaint incorrectly. They may not really understand why the problem occurred. So understanding what that means is far more complex to me than it seems like it would be. I also noticed in the report that there was an other category, and in that other category were things like product design and selling practices, customer satisfaction, how information is given to consumers, advertising channels and practices, all extremely important, but very little indication of what the indicators would be, probably because that's really hard to figure that one out. And then I would also, as my third point, just mention that thinking about how changes in consumer preferences and the ways that we interact with the insurance market are occurring, these are real challenges to supervisors to be more forward-thinking and thinking ahead about new indicators that may be needed. For example, given inflation and a possible global recession, it's likely to make consumers more price conscious and put more pressure on insurers to offer affordable products. So, how do you assess that? The growth of digitalization, which may redefine for some consumers what a satisfactory experience is. So how will that be played out? Concerns about personal privacy, which challenge insurers to explain what information they seek from third parties and why they do that. And then, the list could go on. Calls for greater transparency, concerns about diversity, equity, and inclusion, concerns about corporate social responsibility and/or environmental concern. How are all those things to be assessed as possible indicators for the future? Thank you.
Thank you. So, Fred, I'm really interested in your perspectives in this topic as an insurer, and so I'm curious, what data do you use within your company to know that your products and services result in good consumer outcomes?
As a tech-driven insurer, what we're tracking is the end-to-end customer journey. So we're trying to track every single touch point with the customers. Because we're direct to consumer, we actually get a lot more data than the insurer that relied on the intermediaries. Because most of the time, the data sitting with the intermediary is not passed back to the insurer. I also read the reports. We do also track the claim ratios, the persistency, and the complaints. At the same time, we're more interested in the leading indicators in the earlier stage of the customer journey so that we can understand the root cause, so that we can take actions. So for example, we have data tracking tools like Google Analytics, like Mixpanel, to track the traffics, to track the events, to understand the adoptions of the products. For example, we know exactly how many people click on certain ads. We know how the conversions. We know how much time you spend on the web page. As you mentioned, we don't want people to skip reading some of the product information. We want to make sure that you actually read the disclaimer before you proceed. So a lot of those event tracking that we will put in place. And also, we know how much time they spend watching some of the educational video, and we encourage people doing that. And do they actually call our customer service before applying? And so all of that, we see if there's an uptick in the customer engagement and retention, then it's a good indicator that the product feature is generating positive outcome. But I would say there's more and more unconventional customer data that allow us to analyze the correlation with the desired outcome. And one thing I want to measure, just want to share with you, that we care a lot, is the online perceptions of the product and service. So we do social listening. So we pay attention to everything that people talk about us online. So we actually pay attention to what you search for when you're actually considering us. So social media, forum, blog, Google review, third-party website, even influencer, whatever they say about us, we are monitoring. So a leadership team and a working team, we actually get a report every morning, every afternoon to look at all this alert. And there's no filter. We're actually reading the raw comments so that we can get a sense of some of the truth. And I would say a lot of companies decide to ignore because it's just a comment, who cares, right? But if that comment can tell you, it's an indicator of some of the potential complaints, some of the potential unhappy customers. And if this comment is something that a lot of your customers will read, then we think we should respond directly because of two reasons. One, internal, it will cause frustrations. It will hurt your morale if your colleagues actually believe in the comment. So we think we should respond. And secondly, it's important that we demonstrate accountability and transparency to win trust. So I'd say the voice of the online customers and the social media is actually interesting indicators. And if we have full transparency, the media, the public, the social media will help monitor and regulate the behaviors to make sure that all of us are actually doing something that is good for the customers.
Mark, yeah, we'll come
Yeah,
up.
I'd just like to comment, Fred, that's great to hear, because I think as much as insurance supervisors will try and get conduct indicators, we will never be as good at it as responsible companies who actually want to take the responsibility to understand how well their own products and services are meeting the needs, how they're fulfilling that consumer demand. And Brenda, I mean, that's partly responsive to your comments as well, because we're always one step removed, and we learn from good companies. You learn the companies who figure out how to look at their lapse rates on policies as an indicator that there must be something going on in their sales channel, because there shouldn't be that many people who buy a product and are excited about it, and then 3 years later on a long-term product are getting out of it. Something's going on. It can't just be changing financial circumstances, or how many P&C claims are ending up in court. There's something going on there. There was a misunderstanding, there was a misperception. And so, Fred, my hat's off to you, because I think that is the first line of defense, is companies taking the responsibility for trying to understand their own data and conduct indicators.
Thanks, Mark. Thanks, Fred. So let's pop back to our polling question results. So this was on changing consumer preferences just a moment ago. So 2 front runners, but products that are unsuitable for the needs of the consumer, clearly in front, and then closely behind a product that consumers don't understand. So what do you all think about these? Are these consistent with what you might have expected from a poll question of this nature? Some nodding heads. No. Yeah, Mark?
Yeah, I was wondering why there wasn't an all of the above category, but
Fair enough. Any other insights and Elizabeth, I haven't forgotten that you're virtual. If you've got, I'm assuming you can see the poll results, but would be interested in your take if you have any here.
Yeah, I think it's very interesting when you think about the current environment where there is so much information that's available. It's almost an overwhelming amount of information that's available. And so I think there's an interesting question to ask about, the ability of customers to really understand products when it's not that there's a dearth of information. There's actually so much information, it might be confusing and difficult for customers to really navigate and figure out what's the best choice. I think that's just another thing to think about.
Excellent.
There's worldwide attention to what's typically called financial literacy, helping people learn to manage their money, but insurance is largely absent from that in many of the efforts around the world because the educators don't understand it either. So,
yeah. And we've seen, particularly in my home state of Florida, with respect to flood insurance, a lot of consumers not fully understanding that risk isn't typically covered under a standard homeowners insurance policy, and being told along the way of the home buying process that they're not in a flood zone, when the reality is, if you live in Florida, you're probably at risk for a flood. So we've seen the lack of consumer understanding be a real problem also. So we have one more Slido question, and I've got one more question for each of the panelists, and then we'll see what questions you all have this morning. But in discussing indicators for conduct risk, we have this multiple choice question for you. What's most insightful for assessing emerging conduct risk? So 5 choices there for you all to consider. So hopefully you have that up on your mobile device and are responding to that. In the meantime, we'll go, as I say, to our last question here that I've prepared, and then hopefully you all have been thinking of some along the way. So Mark, we'll start with you again. We're going to talk through some of the supervisory tools that can be used to better embed consumer protection. I wanted to know, in what ways do you think supervisors need to evolve their approaches to keep ensuring that insurers are acting in ways to create good consumer outcomes?
Great. Well, that's a tough question, partly because what is good consumer outcomes continues to evolve, and I talked about that earlier in the sense of changing purchase behaviors, and that means that what good consumer outcomes are going to perceive to be will change. There's also, I believe, a movement afoot, and I mentioned social license earlier, and this actually gets into diversity, equity, inclusion. So good consumer outcomes, I believe, is no longer going to be measured just upon the majority or normative large classes of consumers, but it will be how all major consumer groups, including those who are vulnerable, underserved, or diverse consumers, how they're served as well. And interestingly, in our study in Canada recently, we identified that 50% of vulnerable consumers actually did not have trust and did not have confidence in insurers. So that's a big hill then to climb with that. And when you define good consumer outcomes, taking into account those people as well, it becomes much more difficult. So now, David, let me get more directly to your question. So supervisors, I think, today have to start evolving their approaches because of the amount of change and evolution that's going on in the insurance marketplace. And to do that, I believe you have to get away from being prescriptive and you have to go to being more principles-based and consumer outcomes focused, measuring the success of your supervisory efforts and of the insurer's internal conduct efforts by, is it achieving the outcomes that you want? To do that, as I said earlier, you actually have to have the risk, you have to have the data, and you have to have the analytics to do that. You have to have the people that can actually have the skills and the understanding to turn that data into information which is usable. And you have to be able to think about that then, and how do you then identify risks from the raw data and focus your resources, because the amount of complexity and evolution going on in insurance is immense, and so you just can't, look at the sea. You actually have to figure out where it is you're going to focus your efforts and where you think the storm is going to come. Because of the complexity of insurance and the evolution of insurers, and so with fintech we're seeing lots of new insurance entrants, you also have to think about how you are proportional in your insurance supervision so that it is situationally appropriate. So you can't apply the same techniques to an old line, multi-line company that controls its distribution channels to somebody who's a new startup with a limited product focus and is actually going through an online distribution strategy. You need different supervisory techniques, and you need to be proportional in how you apply them. Final thing is, I think you also have to be transparent, and that's in two respects. You have to be transparent to help consumers. They don't want to often invest the time. They want to spend more time on purchasing a shirt often than they do on purchasing insurance. But you have to give them the information and try to get them and boil it down to even some simple questions so that they can be well informed about what they're doing. And you also have to be transparent about where you are successfully finding problems. And that could be that remediation is required and insurers have to take actions. And it can also be about the enforcement sanctions. We need to communicate with the public and let them know that there is a downside to doing things wrong when you deal with the public. And all of this you can see through some of those changes I talked about before, whether it's the changing distribution channels. In Canada now, more than 50% of life and health products are being sold through managing general agents. And there can be multiple levels of agencies involved, and that changes the role of brokers and agents as the distribution channel changes. Fees, incentives change that as well. Products are now, insurers want to go across borders as much as they can, certainly within countries, but even across countries, and they want to have similar products and services, and so that requires different supervision. And I talked earlier about just the different risks that are changing, so whether that's cyber or natural catastrophe or new products that are coming out from insurance, all those require you to be a supervisor that really focuses on what are the principles and the consumer outcomes you're trying to achieve, and making sure you're doing that in an evidence-based way.
Thanks, Mark. So Godfrey, I'll come to you next as a supervisor. What do you expect of an insurer to ensure better consumer outcomes, and how do you supervise that they're meeting those expectations? Godfrey.
Thank you. I think on our part, we look at a number of outcomes from the market, and one of it is culture. We look at how those companies are focusing on their customers. Are they customer-centric? Are they striving to meet their demands? Are they trying to offer the services that those customers want? We also look at the products that they have brought on the market, and whether those products meet their client needs. We also look at whether they are providing information as much information as is possible for those customers to understand what they are getting into, how will their needs be met by those products. We also look at the kind of advice they give and taking cognizance of the positions of those customers, whether that information that is provided is relevant to what they do really want. We also look at the barriers that they put into place should you want to cancel. should you want to move? Should you want to change that policy? Are you enabled to be able to change that policy that you have taken? If not, then of course there would be consequences. And we also look at the kind of advice that you are given and the suitability of all those that you've been given. And of course, at the end of it all, we also look at the kind of reaction and complaints that you get from your customers. And in the end, we also, to check that all things are in order, we do run surveys. We also we do on-site inspections. And arising out of what we find out, we do take action. But at times, of course, the data that comes in from consumers, from members of the public, doesn't exactly point to where the issues are and the challenges. But nonetheless, we have, through those surveys and data that we collect, been able to deal with some of the things that come up. But we, of course, don't have infinite resources that can enable us to deal with those issues at the same time. But we want to address all those issues. We have addressed quite a number of them. But it is still a challenge to get everybody to where they want to be. To get fairness and transparency is still a big challenge. Thank you.
Thanks, Gottfried. And Brenda, another area that I know you spent some time on, what kind of methodologies should supervisors be using to understand whether insurers are using appropriate disclosure in sales processes?
Mm-hmm. So there are a number of tools that are more widely used in other sectors that allow us to get more direct feedback from consumers. And so one would be consumer advisory groups, either company-based or regulator-based. An example is the National Association of Insurance Commissioners Consumer Participation Program, which celebrates its 30th anniversary this year, and thank you very much, funded my travel here, so I had to give them the appropriate plug. But consumer advisory groups allow industry and regulators to hear directly from consumers and or those who represent them to work appropriately. Obviously, those groups need to represent the diversity that is present among the consumers who are the audience of whatever group it is. And they should be involved in the discussions that lead up to the decisions, not just being told what the decisions are after the fact. Something else I feel strongly about, because it's something I do, is involving experts in crafting consumer communications, including disclosures. We have a different set of skills than people who are in marketing or people who are in legal, who are, they do their jobs well too, but someone who truly understands how consumers read and process information can be very valuable. I would also like to take this moment to make the point that I do not think that a disclosure is a substitute for regulation. Disclosures cannot solve market problems, most of the market problems. Better data collection and greater transparency to data would allow those who participate in the process to be more informed, including examination of market issues such as non-actuarial based differences in the availability and or pricing of products based on regions or neighborhoods. There's some technology tools that are extremely helpful, and there's an online tool called a heat map that allows us to see which parts of a document someone is looking at and which parts they view most often, tells us something about the design of the document and the relevance to consumers. A/B testing, which is here's version A, here's version B. Which one do you understand most clearly? Cognitive interviewing, one-on-one interviewing, where we get to the why. What do you think this means and why do you think it means that? Would you look at this and why would you or would you not look at this? And then I'll also just add one more comment about using objective readability scores, such as the Flesch Reading Ease score, to determine readability. That's a really simple way to decide if something is readable or not, but it is a very blunt tool. The words have an influence on whether something is readable, but so much else does as well. How it's formatted, how it's organized, how it's presented, and when it's presented. If it is presented to me after I have made the psychological commitment to the product, even if I haven't actually purchased it, I don't really care if it's readable. I'm probably not going to look at it. So there are a number of tools like this that I think can help insurers and those who regulate the insurance market do their jobs better. So.
Thanks, Brenda. So Elizabeth, I'll come to you next. Your work focuses a lot on the importance of culture in risk management. So how do you see the link between the corporate culture of an insurer and the delivery of good consumer outcomes?
Well, indeed, there is a growing body of evidence to support what I think many supervisors anecdotally or instinctively understand, and that is that there is a link between corporate culture and customer outcomes. In fact, we recently were involved in a review with the Hong Kong Monetary Authority where we established this link statistically between, the review was focused on incentives for front office staff, including those who sold insurance products. And what we found was that different types of incentives provided to frontline staff led to better or worse perceptions of good customer outcomes. So, for example, specifically, organisations that used customer-focused incentives like rewarding or praising their staff for achieving good outcomes for customers. Maybe it seems obvious, but led to better perceived customer outcomes than firms that focus their incentives on revenue, for example. But to come to the culture piece, we also included some questions that went out to staff. And by the way, we had 20 institutions participating in this review, and it was around 18,000 survey responses that we got back from frontline staff. We included some questions around the general culture of the organisation. And whilst we found a strong correlation between incentives and customer outcomes, we found a stronger one between culture and good customer outcomes. And so this was particularly interesting. It was sort of something that we put in there just to see what we would find. And I will say it wasn't just any culture. The particular types of questions that we asked suggested that firms with a culture that is collaborative, where there is where people feel that feedback is constructively given to staff, that there were people discussed ideas for improving customer outcomes, and where people discuss values of the firm. That type of culture those types of cultures were the ones that had better perceived customer outcomes. So I think the message for supervisors is really looking at how they can understand in an evidence-based way the culture of the firms that they supervise, really can give them insight into the ones that they potentially might want to look more closely at. And just to touch on how that can be done, because I think it's often a question that supervisors think, well, how would we get a really evidence-based view of culture in an institution when we are external to that firm? There are, in some jurisdictions, an increasing appetite and examples of supervisory bodies that are going directly to the staff in those institutions, as we did in Hong Kong, and asking them to share their views about the culture that they are in every day. And I think there's a lot of interesting insight that's being gained from jurisdictions that use that approach. So yeah, I think it's very worthwhile for supervisors to be looking at the culture of a firm as an indicator or a predictor of which firms might be worth looking at more closely.
Excellent, thank you. And then Fred, we'll come back to you. A similar question to the one I posed to you at the last round, but what kind of approach do you take through the product development stage to ensure good consumer outcomes?
There are actually lots of different product development framework, but I just want to share some of the questions that we ask ourselves when we do product developments. It's some simple questions that apply not just to insurance, can be applied to any other products, and it represents some of the principle and value. And the first one is quite simple. It ties back to the mission and value is, will you buy this product for your parents? Will you buy this product for your spouse? If the answer is a clear yes, then I think you fundamentally believe that there's a good value in this product. But if you hesitate, there might be there's something wrong that you wouldn't even buy for your family. And in fact, a lot of products that we launch, especially during COVID, the idea is coming from the needs that our colleagues and family are looking for. So we're the first one who launched the CT scan reimbursement for COVID cases. And we're the first one who launched reimbursement of the COVID test kit, because everyone was looking for that. And we thought, okay, if our colleagues are looking for that, maybe this is something useful. So this is to us, it's a good indicator that if our colleagues and family need it, then maybe our clients need it too. And the second question we ask is about the customer discovery process. Is this something that you really need? And does it solve the biggest pain points? So we form a small cross-function squad with designer, with actuaries, medical doctors, marketers to carry out this discovery phase. Then we have a lightweight 6-week agile cycle for the engineering to build out. We guide the team in a very early stage of the product development stage to align the product visions, to understand, to define the markets, define the segments, and then we test the demand at the lowest cost. As a startup, we always test the demand as the low cost, meaning build an MVP and just keep on iterating. Because the worst scenario is you build something that no one wants. But you want to just build an MVP without actually doing the proper pricing and everything, just test the market first. And most of the time, you realize there might not be a market for it. And the last question I find it quite interesting is to test the product market fit. Some of the tech company will ask, how disappointed are you if our product no longer exists? There's a survey that if 40% of the people are very disappointed, less than 40% of the people are disappointed, then maybe your product is not that important. Maybe your product is not solving the highest pain point for the customers. So these are just some of the examples where, without going into too much detail or technical details, we ask ourselves, is it a good product? But last point I want to make is some of the product innovation may not work. We still, as a new insurer, we still have the startup mindset. If we want to introduce substantial innovations, not marginal improvements, substantial innovations, then you have to take the risk that your product may not work and may not fit the market. But it's still important that we invest into the experiment. It's important that you explain to the colleagues that some of the product might not work. It's actually good to fail. But of course, we have to make sure that we don't launch it to the market and make sure you satisfy all the regulation. But if you want to succeed in doing substantial innovations, then you do have to invest in experiment. You do have to accept the fact that I heard one of the fintech company, they said only 10 to 20% of the product actually work. So 80% of the product idea didn't work. They didn't launch to the markets. So that is a good rule of thumb to keep in mind.
Great, excellent, thank you. So I think it's time to bring up the results from our last Slido question. So we'll bring that up now. Consumer complaints data is the most insightful. So, and then cancellation lapses and non-renewals. And I think as I go about my day-to-day as a supervisor, I think that's fairly consistent. I think the claims rejected and claims withdrawn, I thought that might be a little higher. Any takeaways from these results? All right. I think, Brenda, it speaks to your comment earlier about making sure we've got a robust process for consumer complaints and understanding what those mean. So I think we've got just enough time left in our panel. If there are any audience questions, we have microphones that I think are running around the room. So if you'll we have one here in the front. Thank you. So if you give us just a second, we'll bring a microphone out.
Thank you very much. Michaela Koller, Insurance Europe. I have a question regarding, in fact, I have two questions, if I may. The first is about regulation presenting a risk when it comes to conduct. Because in Europe, for example, if you want to sell an insurance-based investment product, you have to give the customer 190 information points, pre-sale in the pre-contractual environment. Obviously, that is a huge challenge for any customer to understand, and I think we had a very good discussion around financial education levels. Now, compare that then to what we call in Europe the finfluencers. And I have a case in my own family where my 25-year-old daughter, is looking for a product to invest, And I tell her, make your own research and see how it goes. And she comes back and she said, you know, I went out, I'm a digital native, and from the traditional operators like banks, insurance companies, all I get is complication. And all I get is also, you know, a lot of explanation that I don't understand. She showed me, in fact, an information sheet with 30 different information on cost data and asked me whether I could explain it to her. I work with European regulation for the last 30 years, and I couldn't, and I'm a lawyer, you know, so it's a challenge, I think, for people who really want to buy. And then she tells me she goes on TikTok and finds an influencer who explains it to her. And it's all very simple. So how do you grasp this? What role does regulation play for the traditional industry? You know, does it also lead to making it very hard for the industry to be transparent, to explain products well? And then how do you grasp influencers that are obviously not subject to any regulation, at least currently?
So thanks for that question. I'm sad to hear somebody has stolen my dream job of TikTok insurance explainer, so I'll have to think of something else. I don't want to put anybody in the spot, but Brenda, you spoke of disclosures a little while ago, and I wondered if you might want to start us off on this one, and would welcome insights from anybody else on the panel as well.
Yeah, so just a couple of basic points. You know, one, I can't simplify the information about a complex product. Now, maybe this wasn't a very complicated product, but product design comes into this. So the more complicated our products are, the more information we should be giving to consumers, but the less likely they are to be able to process and understand it. And then it also goes back to my point that consumers who don't have fundamental understanding of what the product is and what it does really can't be expected to appreciate and use information about that product, because if in the first place they don't know why they need flood insurance, then it's really hard for them to again assess that information. And so on the one hand, providing more information seems like a useful tool, but we know from consumer research there's something called information overload, and at some point we stop thinking about this. And again, with insurance, if I really don't understand it, why would I look at all of this? I would just assume it's what we call an experience good, and I will find out after I buy it whether I made a good choice or not.
So we've got about 5 minutes left in the panel. Maybe time for one more question.
Mark wanted to say something.
Oh, I'm sorry, Mark. I didn't mean to cut you off there.
No, I was just going to say, I do think it's incumbent on regulators to find ways to be flexible. And, we're developing an innovation framework where we have some exemptive powers, and we'll use some of other powers to use discretion to run controlled consumer trials, which would not have to have, for example, the required amount of information that might be suitable for, because those 190 information points, we're probably looking across a broad array of products, and if something was more targeted, I think we need to find a way to give supervisors discretion so that they can focus in on, out of those 190 for this product, it's really 10, right? And those are the 10 that you focus on, and let's see how that goes, and allow that type, because otherwise you're not going to offer the choice, and that consumer value will be lost. And also, of course, fintechs will try and come in, and by the way, they should be regulated, same activity, same risk, same regulation, but I understand that's not always the case.
All right. So one brief question. I certainly don't want our panel to be the reason the whole day falls behind. So one more brief question
Okay,
here.
just brief question. Yoshika Wei from OECD. Just for new startup type of your insurance company, how do you see the potential to sell traditional life products or automobile by online? And do you have any requests to regulators to facilitate launching the new product? And if possible, regulators, now assuming that we have a lot of on-demand product, and some of the on-demand product is try and error, but our tradition is just assess the product, very strictly control. So how do you adapt? Are you ready to adapt on-demand product authorization, or how to make launching that type of product, if you have any idea? Thanks.
I'm trying to take that. For us, we focus on health insurance. In Hong Kong, as I mentioned, there's a protection gap of 900 billion. Because of that imbalance, we're relying on agents. We see that we're not selling enough peer protections. So one of the mission for us, because we are able to demonstrate a much better unit economics online. Because one platform, we can serve so many people. So we're able to sell, put this back some of the peer protection product online and for people to access them. And we think we're opening up a new market because a lot of these people who we targeted, they are actually not buying from the agents. They actually don't want people to sell them. They actually want to be in control. And I look at the survey about the preference about price is the first number one categories, right? I think if you're rational, you could say prices. But we look at some of the survey, if you're emotional, you actually don't want people to push you to sell. So I think back to your question is our license, we can do life insurance, we can do health insurance, but it's our responsibility to make sure that what we put online is something that the customer can understand. I think that line we need to be responsible. I think it's irresponsible to just put all the disclaimer online, put a very complex product online to assume people will understand. So we have to draw the line to make sure that for the people that we targeted can understand and at the end have a good customer outcome. We are not focusing on demand insurance product at this point. We're focusing on pure health insurance, medical reimbursement, and because it's such a big market, we decided to be very niche to just focus in health. And health insurance is a good product for the younger segments because of the touch points and because for term life or death, they might be a bit remote. Our customer base right now is around 30s. 1/3 of them are below 30, so it's quite young. And these are the segment that prefer online rather than having people to sell it to them. Yeah.
Great, thanks for that. So that is going to bring us to the end of our time. If you had a question, sorry if you didn't get to ask it, but if you wouldn't mind, please join me in thanking our panelists this morning.